If you're exporting anything out of India, you know there's this one document that can be a real pain, or it can be your golden ticket. Well, today we're going to decode the Indian Shipping Bill. We're going to break this whole thing down and show you exactly how to use it to get your goods out into the world.
Look, whether this is your first time exporting or you're a seasoned pro, you've got to get this document right. Why? Because honestly, it's the difference between your goods flying through customs and you getting your tax refunds on time or, not.
The easiest way to think about this is like a passport, but for your goods. Just like you can't get on a plane and cross a border without your passport, your products can't leave the country without this. It's really that simple. No bill, no export, and maybe most important of all, no tax refund. All right, so let's get into the nitty-gritty. The best way to really wrap our heads around this document is to see it in action, right? So we're going to follow one single shipment and use the shipping bill as our map, section by section.
So what's its main job? Well, at its core, you're basically telling the government three simple things: what you're sending, where it's headed, and how much it's worth. This isn't just a piece of paper. It's the digital handshake that gets the whole export process started.
Now, if there is one section you have to get right, absolutely perfect, it's this one. I like to call these the three golden keys because, getting these three little details correct is what unlocks your tax refund. So what are they? First up, the port code. Which specific port are your goods leaving from? Second, the shipping bill number. That's the one-of-a-kind ID for this exact shipment. And third, the bill date. These three things combined create a unique digital fingerprint that the tax system is looking for.
And here's why that fingerprint is so critical. The tax department uses it to match your export with your tax filings. The port code, the bill number, and the date on this document have to match perfectly with what you file in your GSTR-1 tax return. Any tiny mistake here can cause huge delays in getting your money back.
So once you have those key identifiers locked in, the bill starts to tell the story of your shipment's actual journey. Let's take a look at how it maps out the trip from your factory all the way to the port.
This next section is kind of like a profile for your shipment. It answers some really basic but super important questions. How's it traveling? Is it going by road to Nepal or by sea or air? And what's the whole point of this export? Is it a standard sale, or are you maybe sending goods back that you repaired for a client? That's what's known as a re-export.
Okay, so what actually happens when your stuff gets to the port? The bill tracks this whole process, step by step. First, your documents are submitted. Then, customs officials take a look. They might even decide to open a few boxes for a physical check. And nothing, nothing, gets loaded onto that ship until you get that final, crucial stamp of approval, the Let Export order. All right, next up is a section that's usually full of acronyms, which, let's be honest, can be a little intimidating. But this is actually where you make some really important financial decisions about your export. So let's simplify the main government schemes you're going to come across. This brings us to a huge choice every single exporter has to make, and it's all about your cash flow. Do you want to export without paying the IGST tax up front? You can do that. You just file something called a Letter of Undertaking, or LUT. Or do you prefer to pay that IGST now and then claim it back as a cash refund later? The choice is totally yours.
Okay, let's talk incentives. A really common one you'll see is DDBK, which stands for duty drawback. Just think of it like this. If you imported raw materials to make your product, this scheme lets you get a refund on the customs duty you already paid for those materials. It directly lowers your cost of production. It's the government's way of making sure you're not exporting your taxes.
And another big one is RODI-TEP. Now, this is a bit broader than DBK. It's designed to refund all sorts of hidden taxes and duties, from the central, state, and even local levels that might be baked into the cost of your product. I'm talking about costs you might not even realize are there. Getting that money back makes your products way more competitive on the global market.
Okay, we're on the home stretch now. Let's look at the final part. This is where you declare the value of your shipment and make that final declaration that leads to a successful, cleared export. Victory! Now here we've got a simple but absolutely vital detail in international trade, FOB versus CIF. Are you declaring the FOB value? That means your responsibility for the costs ends once the goods are on the ship. Or is it CIF, where your price covers the insurance and the freight all the way to the buyer's port? Getting this right is crucial for both you and your customer.
And finally, the last step. This is it, a formal, legally binding declaration, usually submitted by a customs broker, that says everything on this bill is accurate and true. With this final check, your goods are officially, finally cleared for export.
So if you take away just one thing today, please let it be this. The number one reason exporters have the refunds delayed isn't some massive fraud, it's a tiny mismatch. A small error between your invoice, this shipping bill, and your GST filing can lock up your cash for months. When it comes to this document, believe me, accuracy is everything.
So there you have it. The shipping bill isn't some scary puzzle anymore. It's a map. And now that you know how to read it, the world of exporting is way more accessible than ever. Thanks so much for tuning in.